Welcome back to our key area number 3. We're going to be looking at international investment appraisal. So this means that we've got investment or we spend money out somewhere overseas country, so we need to bring those cash flows back to our country. So that's why when you're required in the example area number 8 to conduct the international investment appraisal, that you will need to set up two parts cash flows table here. The first top half will be related to you've got the foreign subsidiary. So that's why the currency here will be the foreign currency. Now you've made profit in overseas countries, and then you need to bring those cash flows back to your own country. So that's why we've got a second part where we're going to be dealing with our own currency. All right, simple. However, the way that we predict the future exchange rate, we always use the purchasing power parity theory according to your formula sheet. So let's give you a very simple example. So the current exchange rate, which means the current spot rate, is £1 equals to $2. And the pound in year 1, the standing for example, if we were to use the inflation from the UK, because that's what PPPT or the purchasing power parity theory is all about. So that being the case, as we can see there, the year 1 predicted exchange rate, firstly we'll take the spot rate on the left hand side, the first currency, which means the variable currency, standing for the USD. That inflation is 15% there, so we slot that in the numerator. Denominator will be the second currency inflation rate. That will give me the year 1 predicted exchange rate of 2.09. So we then base on 2.09, doing the same calculation from year 2 for the difference in inflation, and that will give me the predicted exchange rate to be 2.13. And that's all we can say. Alright, so anything else, of course, for the international investment appraisal as the narrative part, you'll always be required to comment on, for example, the risks, for example, the political risks, economic risks, and so on. Nothing else. Sometimes the international investment appraisal could be tested in combination with APV, which means the adjusted present values that we've seen in the last key area. So make sure to stay ready. But from my perspective, the best way is to practice the past exam questions to see how we can do about it. The very good exam question is called a money company and basing in the country called Ulandwe. Now, let's see the requirement firstly. Discuss the possible benefit and drawback to a company of setting up the own assembly plant in Ulandwe compared to licensing a company based in Ulandwe to undertake the assembly on its behalf. So this means that if I were to use the organic way to set up the business in the Y country, so that's our first option, and of course that will take time and management expertise to do that. Compare that we produce the item in our own country and to sell the item there, and of course the Ulandwe company need to pay us the licensing fee each and every time, that for example is the annual fee or something. Of course, the upside of doing that would certainly be we reduce the initial investment. So by doing that, and at the same time, we can guarantee, for example, the very stable cash flows that we can receive each and every time there. Now, 5 marks, we simply write 5 points related to that. Now, this part's related to the first part of the question. As we can see there, it told Ulandwe, using the YR as the currency and having economic challenges and it's quite poor, but they are well educated. Okay, people that are educated, they're well educated, and we've got the tax rate, inflation, because the government is doing a good job, but strict monetary and physical controls, which means that not really inputting a lot of money into the society, which means people in that country will find it difficult to borrow money from the bank. And physical controls, which means perhaps the tax rate is a bit high to bring down the inflation. Okay, making the government popular in larger cities and towns, but less popular in rural areas. Okay, and expecting that the inflation rate would calm down, and the government decided to continue the progress made so far, encouraging foreign direct investment to the country. Okay, right. So we can write something there. So related to part A, the things that we can say is that firstly, read through the requirements again. The setting up our own assembly compared to licensing. All right, so we are focusing on, we use the organic growth. And the benefit of the organic growth, we can talk about to improve quality control for our product, ensuring everything, for example, our staff receive training. And of course, we can also consider the possible new chances that we can work, okay, in the country here. But there'll be a lot of drawback that we can say. So for example, it will be high investment, and also that we will need to consider the risks in that country. Now, bullet points will not give you any marks. So that's why the best way is to use simple sentences and then to slot the information from the case into your answer, from the case into your answer. Now, so firstly, that the quality control, okay, can be done properly. You can say that, what would be the implication of that? Okay. So of course, it can protect our brand or reputation. So possible applications to the case that we can see that as our country is called a money company, that is a large listed company. So because I don't want to affect negatively our share price. This is a public listed company. So at the same time, that training will be much easier, because if we were to expand our company in that country, so for example using the franchise way later on, the training can be controlled, okay, by our company properly. And so of course we can enjoy new chances. For example, that later on we can do, for example, the M&A, mergers and acquisitions, given that they had economic difficulties currently. So I would say that there would be lots of difficulties that the company will be operating in that country. So it would be cheaper for us to expand, perhaps. But high investment, so for example, we may find it harder to borrow, given that it has got tight monetary policy. And so also we need to consider risks in there, particularly the economic risks, that the purchasing power of people, because we're told that they're poor, they're not rich. As you can see, each point you don't really need many words to describe your idea, because when marketers are marking a script, really depends on whether or not you touch the right point, or whether or not that's reasonable, and whether or not you're touching back the case. And you will be awarded marks directly. Just 5 marks, 5 sentences, absolutely fine there. Moving on. To the part B, prepare a report. Alright, so as a starting point now, so in the word processor, alright, in the word processor, let's talk about that report. In the word processor, let's talk about the report. So you need to have the subject of the report, and in this case, clearly, it's the international investment appraisal. And then the introduction paragraph. So all we need is don't be so clever. So you touch the keywords, or you simply copy and paste all of that. So copy and paste all of that. So I will say that this report will evaluate blah blah blah, discuss blah blah blah, and then provide blah blah blah, and so on. Okay. Now, the next things that we need to do, because it evaluates the financial acceptability, so all we would do is that we could copy again in our answer 1, 2, okay, directly formatted, but it's fine, and 3. This is number 2. Okay, we do that again. So that's number 1. And then that's number 2. And then that's number 3. So what you need to do then is to underline each of those as your heading. Don't forget, you've got conclusion in the end. So conclusion in the end is that, well, yeah, make recommendation. We should invest in that. So the number 3 is the recommendation. Yeah, the conclusion is what you would need to consider in the end. For example, is the sensitivity analysis or so on. Okay, you can always put that in. Once the marker can see that you've got a report, you've got a subject, you've got introduction, you've got headings answering all the questions, and you've got a conclusion, that there will be 4 professional marks. So namely, the communication mark here will be marked as 4. Okay, so that will be as a starting point. You can't lose these marks because these are easy marks anyway. Now, let's read through what each of the requirements tells us to do. Now, investment in assembly, all right, in Ulandswy. Now, let's go back to the case and to see what is going on. Now, here we're told about the tax rate, 0 tax rate in the first 2 years. We can also carry losses, okay, after the second year, to offset against future profit. And government representatives also promise international companies with good transport links, so that's why it can reduce our risk that we can put that into Part A, but we've done that. Now let's talk about our company. Now we're basing in USA, and we got US dollar as our currency, and we make machinery and export machinery worldwide. Now, our company is considering setting up assembly plant, okay, where parts will be sent and assembled in a component which is currently being assembled in the USA. But now we'd like to set up a factory there. Once assembled, components will be exported directly to the companies based in the EU, and we sell and we invoice in euro. All right. Okay, so got that there. So assembly plant in Ulandswy initially assumed the project will last for 4 years. All right, so let's plot that in. The appendix, we'll say that it's the appendix, but we have to say that. Okay, the markers will check that in the Excel, but You can say that, append this number of years, 0, 1, 2, 3, and 4. The 4-year project required investment of 21 million at the very first start. Alright. So it's fine now. And for London buildings, 18,000 for machinery and 9,600 for working capital. Okay, so the investments that we need would be, if I were to use all of them in million, and that is in Yulandwi currency, the investment at the very first start, we've got 21,000 and 18,000 there. So equals to minus 21,000 and 18,000 there. Okay, let's take that off. And also we've got the working capital needed. Okay, so WC, or working capital, that we need 9,600. All right, 9,600. But working capital increase annually at the start of the next 3 years at the Yulandwi's inflation rate. Okay, so all we would do, as always, we start working next to that. Okay, for the working capital. I've got number of years, 1, 2, 3, and 4. Working capital in total. Of course, we start with 0, 0, 1, 2, 3, and 4. Okay. Now, what we need, at the end of year 1 will be to inflate that 9,600 in year 0 by the inflation rate. So starting with the 9,600, and we need to see the inflation rates of Yulandwi country. So at the very first start, we read the questions so we can see the inflation rate of the Yulandwi of 22% in year 1, 14.7% in year 2. Okay, so 22%. So which means, open the bracket, 1 plus 22%, and then year 2, we take this timing by, open the bracket, 1 plus 14.7%, and then year 3 onwards 19.8%, so equals to this timing by 19.8%. Okay. And year 3, and even in year 4, 19.8%. So that's why the changes from year 0, the left-hand side will be 0, 0 minus 9,600 being 9,600 up front. And then we take left-hand side minus right-hand side for year 1. That would be 2,000, all right, 112. Left-hand side minus right-hand side, left-hand side minus right-hand side, and then left-hand side minus right-hand side being 0. Okay, so that's all we can do. Okay. But at the end of year 4, here we are told this will be released at the end of the project life, and that being the case, that year 4 will not be this figure. All right, year 4 will not be this figure because year 4 that we like to release that. So that's why at the end of year 4, I will say that it will be the sum of the working capital changes that we could release back, okay, to our company. So being this figure. Okay? So make sure you're ready. So let's slot that back. The working capital is equal to the year naught. It only reflects that changes. Alright. Of course, you can round it to be these figures. Good. Now, next paragraph. It can be assumed that the assembly plant can be built very quickly and production started almost immediately. Alright. But this is the assumptions that we've made, and therefore in the part 2 later on that we can challenge that assumption that whether or not there will be delays, okay, in starting a project. Okay, and also it's the ethics part, okay, the school will close and so on, so we need to consider that later on. But next one, the current selling price of each component is €700, and price is to increase in line with the EU's inflation rate. Okay, so we say that later on. And related to the exchange rate, so we will need to convert that into the Yulanzi Ren, okay, which means the YR. Yeah, because looking at the structure again, that we're told, considering setting up a plant in Yulanzi and assembled in the USA, once assembled, the component will be exported directly to companies basing in EU, and we will receive we will receive euro, and that's why when we are assessing the financial acceptability of the Yulanzi project, we need to convert that euro into the Yulanzi Ren, okay, that currency. And that's the big problem, and that's why we need to understand the profits that it has made so far. So that's why we need to start working on this, why not? Okay, so start working on profit. Firstly, we need to compute the sales revenue at the very first start. Now, sales revenue, that's meaning minus any costs associated with that. Now we've got years 1, 2, 3 and 4. Firstly, we've got selling price. Don't forget, it's in euro. By how much? We told about 700 in year 1, because we'll settle a factory there, and we'll make sales revenue after that. But the current, I'll say that from year 1 onwards, the current selling price of 700 will be from year 0. So that's why that in year 1 onwards, EU's inflation rate, next page that we can see, the forecasted inflation rate, here, expected inflation rate for EU, next 2 years will be 5%, from year 3 onwards will be 4%. Alright? So equals to 700, timing by 1 plus 5%, and 735 timing by 1 plus 5%, from year 3 onwards 4%. So equals to this, timing by 4%, equals to the year 3 timing by 4%, or 1 plus 4% now. Now after that, we need to see how many units that we've sold after doing this project. Now we're estimating on the next paragraph that the sales component unit will be all in thousand, alright? All in thousand. But just put all the numbers in, so 150,000. 150,000, and then 480,000, and then 730,000, and then 360,000. So we can work out that total revenue. We take the selling price and timing by the unit, and then we drag it here. But don't forget that we will need to show that in yuan-to ren, which means the YR currency. So that's why we need to see the exchange rate. The exchange rate from euro to YR, we can see that there, because the examiner has calculated the expected exchange rate using the purchasing power parity theory for us already from year 1 up to year 4. So you take 165 and then 180.2, 190.2 and 200.8. Now that exchange rate was quoted as what? As per 1 euro will be the YR. So YR to 1 euro. It's all in euro here, okay, per 1 euro. Now, you see per 1 euro that it can exchange 165 YR. So that's why in YR we're simply timing them all together. So this times by that, the figure is huge, and that's why I would like to divide into 1 million. So 160. You just copy that this each and every time, yeah. You just drag it here. That's all. That'll be total revenue. That you can highlight that in yellow. It's entirely up to you. It's my habit. Okay. Anyway. Right. So moving on. Because we need to calculate that profit, we've worked out the revenue already. Now, next paragraph. The parts needed to be assembled into components in yuan-to, same from USA, at a cost of 200, and from which we'll earn a pre-tax contribution of 40. Alright? So which means that we will be selling at 200 and the variable cost will certainly be 160, yeah, because the contribution is 40. However, our company feels that it can negotiate with the government and increasing the selling price to 280 per unit, and that's why the 280 will be our variable costs. Okay, and let's talk about the variable cost here. Now it's 280. And we also have got other variable costs of 15,960, but we need to work out that dollar side of 280. Now, if you can go to the USA expected inflation rate, that'll be from year 1 onwards will be 3% there. Alright? So the year 1 will be equals to 280, timing by 1 plus 3%. Drag it here. Okay, that's a starting point. And then of course we can slot the unit, okay, so equals to this one, and then drag it here. And then we can calculate the total VC, or variable cost here. So we take this timing by the unit and drag it here. And remember that total variable costs would be in dollars. But we will need to work this out in the foreign currency. And that's why we'll need to see United Ren per USD from year 1 onwards, okay, would be the first table. So we just copy 120.1, okay, as the exchange rate. So 120.1, 133.7, 142.5, and 151.9. Now to work out yuan-to ren simply timing all together. So in Yuland we ren, okay, although it's a fake country anyway. So simply take this and timing by this, the amount is too large, and that's why in all medium, so over 160. So these are the total variable costs here. Now, how about other variable costs? Because we're told about the other variable costs are currently 15,960 per unit. All right, expected to increase by the country's annual inflation. And that's why that we would like to say that other variable costs, again, currently has nothing to do with the exchange rate because it's in YR currency. So currently 15,960. How about in year one? In the overseas countries, that the inflation rate in Yulan's way is 22%. All right, so equals to this timing by 1 plus 22%. And then basing on the latest figure and timing by 14.7%. So 1 plus 14.7% equals to this timing by 1 plus 19.8% equals to this, and timing by 1 plus 19.8%. So these are the other variable costs that we can talk about. Okay, other variable costs here. But these are in single term, and that's why we will also need to calculate the total term. So total variable costs in Yulanzi ren, we take the variable cost per unit timing by the number of unit, okay, and then we divide into 1 million. We drag it here. And that will give me the total other variable costs, right, here. Now how about the fixed costs? Okay, so you need to make that adjustment. Okay, quite a lot of adjustments that you need to do. We're told the current fixed cost will be 4,600, and to inflate that up again. Starts-wise, the fixed cost is the easiest part. So that will be 4,600, and for the year one, because the inflation rate will be 22% for year one, so equals to this timing by 1 plus 22% equals to this timing by 1 plus 14.7% equals to this timing by 1 plus 19.8% equals to this timing by 1 plus 19.8%. Alright, so these are the total fixed costs that we can talk about. Alright. So therefore, when we work out the total profit, because that's what the working is all about. Alright, so we take the total revenue minusing all these costs. So the total profit now is from year one onwards, and that's why starting in year one, we take the revenue in YR and to subtract variable costs and to subtract total other variable costs and to subtract fixed costs all in million and drag it here. And this is what we are focusing on. Let's load them back into our pro forma, the profit from year one onwards, that equals to this cell. Press enter. Okay, and then drag it here. Okay, just leave it there, really. Now, let's also move on, and let's move on that we pay tax on that, we'll deal with that later on, but we'll also expect annual royalties from the assembly plant to be made every year. Alright. The normal annual rental royalty fee is $20 million, but our company feels that it can negotiate this with the government and increasing the royalty fee by 80%, which means 20 million timing by 1 plus 80%. So which means that we'd like to take 20 million timing by 1.8, and that would give me 36 million for royalty, and not subject to any inflation over the next 4 years. Now, what that means is, if you go back to what we're currently doing, is that we are considering setting up assembly plant in New Lansbury, okay, and then we send to the companies that are being assembled in the USA, but the component will be exported directly to companies based in the EU, and we will be receiving the euro royalties, all right, in the foreign country, which means YR, and that's why we will receive that royalty of 20 million that would be part of a overseas project of 36 million here. So that's why we will need to deal with what would be the currency in YR. So that's why here, so that we've got royalty income as well. Alright, so we need to start working next to that. Now, next working is all about the royalty. So again, we've got a number of years, 1, 2, 3, and 4. So firstly, we've got royalty. So it's in 20 million, okay, all in million. But we'd like to increase that by 80%, okay. So will be the same as 36 in each and every year, but this is in dollars, and that's why we'll need to see the exchange rate. You learn with yen and dollar. Now you learn with yen and dollar. Each and every year the exchange rate will be 120.1, and then 133.7, 142.5, 151.9. So that's why to convert into YR, so all we would do is to take this and timing by the exchange rate and drag it here. So that would give me the total royalty income for each and every period. Okay, that we'd like to receive from the parent company's point of view, but from foreign projects' point of view, that would be a payment. All right. So remember, that would be the expense for foreign project, and that's why later on in the second half of our calculation, we'd like to bring that in as our income. So from year 1 onwards, that will be a negative side of 4323.6, and then you drag it here. Okay. Now after we've done with these, I mean quite a lot of calculations we've done with that already. The next thing will be relatively straightforward, because we need to calculate taxes. And when we calculate taxes, of course, firstly, we'll need to less any capital allowances, okay, to save us tax, for example. Let's read through the question again. That related to taxes that tax allowable depreciation is 25% on machinery only. The machinery investment, we are told at the very first beginning, would be 18,000 million YR. So that's why we take 18,000 and timing by 25%, all right, on a straight line basis, so on cost, in other words. So that would be, minus 25% and timing by the 18,000 for machinery. Okay, so the capital allowances. For each period. So what we will do is to revise the profit, okay, so underline this. So that would be the profit minusing the royalty expense and to minus, which means plus, the negative capital allowances. So we would like to pay tax basing on these, okay, profit. But don't forget that we've made tax loss, all right? That we can enjoy the tax loss. If you can't remember that, just skip that. Okay, no big deal. But at the very first beginning that we're told about zero tax rate for the first 2 years, and we can carry forward tax losses after the first 2 years, all right? So which means that the tax losses, they can use that only from year 3 onwards. So we can use that here, okay, the tax loss. So we can calculate the revised profit, okay, so that will be equals to the sum, okay, of these. So you can calculate the tax, so less tax that we need to pay for. Because for the first 2 years will be zero tax rate, and that will be no taxes at all. However, how about in the third year? So what will be the tax rate in the overseas country? Let's just find a figure. Now in the second paragraph, at the very first beginning of the question, you can see in Yulan's the corporation tax rate is 40% there. So equals to minus 40% and timing by the revised profit. Okay, so that being, we need to pay profit, sorry, we need to pay tax on profit, okay, by these two amounts. Now remember, we've less any capital allowances, but capital allowances will not be cash flow, so it will not be reduced by that amount. So that's why we need to plus them back. So plussing capital allowances back, which means equals to minus that amount, okay, so plussing these back, in other words. Okay? And of course, the tax losses that we minus up, and also that we need to add back any tax loss. Equals to minus this one. All right. So we've done with the working capital and we've done with the investment. So now let's talk about the net cash flows, okay, in the overseas country. So it's in Yulan's Ren, all right? That'll be the cash flows there. So firstly, in year 0, if we were to sum these two, and that will be 48,600. So how about in year 1? Okay, how about in year 1? Now, we do it separately. Firstly, that we've got, for example, the profit and paying taxes and so on. So that's why, so firstly we got the revised profit, and then paying no taxes, and adding back. And then we also need to consider the working capital, okay, plussing that. So that will be this one. Now how about in the second year? That'll be the same here, yeah. So we start with the working capital at the very first beginning, and then we adjust all these profit, Okay, revised profit here. And then we less no taxes, then plussing back the capital allowances. Of course, plussing back the tax loss, but we've made nothing there, so drag it here. All right, okay then. Now, of course, once we've finished the first top half of the foreign projects cash flows, now we need to bring this back, okay, to our home country. So that's why the related to exchange rate, so we need to convert that into USD. So from YR to the USD, the current spot rate is 101.4. How about in year one? Now, how about in year one? That is 120.1, and then 133.7, 142.5, and 151.9. So net cash flows in dollars. So this is per USD. The first currency is the same, and that's why we'd like to take this, divide this into the exchange rate. That would give me this amount net cash flows in our home currency, for example. Okay. We can round this to no decimal places, for example. Now, of course, again, our company will be receiving back the royalty, okay, as we've seen before. So that's why we'll need to deal with that, the royalty back to home country. Now in USD, as I said, is just to be 36. However, in our country, we need to pay tax in the USA by 20%. So in each and every year that we like to take that 20 million timing by 1.8 and timing by 80%. So like to receive 28.8 for each and every year. And of course, a small adjustment here is all related to the contribution. All right, because we can see the contribution has changed, because currently the cost of 200, pre-tax contribution of 40, and that being the case, the variable cost should be 160. But now, if we were to increase the transfer price of 280, and that being the case, the new contribution would like to take that 280 and to subtract 160, that being 120 here. And of course, the 120 will be subject to inflation in our country. In US, the inflation rate is 3%. Okay. So the new contribution they'd like to take, the 120, and timing by the number of units. The number of units that we sell will be 150,000 in year one, and then of course we express that in million, so over 1 million. But at the same time, we expect to increase by 3% in each and every year. And for that contribution, we need to pay tax, a tax of 20%. So it times by 0.8. Okay. So we just copy that. How about in the second year? Of course, we like to change the unit to this one. Okay, it's 480. At the same time, for a power of 2, for the 1.03, 48.8. and then slot the pro forma, and to change the number of units, not J3 anymore, but a number of units is 730 for the first year, and for a power of 3, it's that inflation. And finally, slot that for a power of 4, and then the number of units would be this one. Okay, just press enter. That would be 38.89. So once we've done with that, the total cash flows in dollars, let's sum all these down. And then finally, to discount at what will be a discount rate for this project, we were told we use the project-specific discount rate of 12%. Okay, 12% there. So equals to 1 is 0, and equals to 1 over 1 plus 12% for the power of 1. Close the bracket, press enter, and drag it here. So you can calculate the present value using the total cash flows, timing by discount factor, drag it here. Total NPV, or the NPV of a project, will be the sum of these present value. Press enter. Okay then. Now of course, we also have got another table for redundancy and loss contribution. If we were to undertake this project, these are the costs there, but these are so small. So you can, of course, to subtract all of these, but it's entirely up to you. So the total cash flows here, you can also say that we'd like to less any redundancy costs, to slot that back of 20,000 and so on, but it's all in million, so that's why it's 20,000. So you just subtract that, and over 1 million, 160. Okay, just copy that, and 55,697. And then 57,368. And then 59 and 89. It makes no difference, it seems to me, but we need to update that. The sum of the total cash flows here up to this point, yeah, that's all we can do. Okay, now if you do the calculation, any one of them correct, that you will get 1 analysis evaluation mark here. All right, so not a problem at all. Let's answer the boy 1, 2, 3 evaluates the financial acceptability. All right. So I'd like to say to the examiner, they like to use bullet point here, but you can't use that in the exam, but just for illustrative purposes, that the NPV greater than 0, which means we should accept the project from a financial point of view, because this will increase shareholders' wealth by what we just calculated, basing on your result, 131 million. And by saying that, you'll get 1 technical mark because it explains the implications. So that's why 1 analysis evaluation mark here. Okay, as a starting point. Next one, discuss assumptions made in the estimate and other risks. Let's So there'll be quite lots of assumptions that we've made. And risks. How many marks are there? 17 marks are there. So approximately 17 sentences on that. All right. Now, it's the assumptions firstly related to cash flows that you can say that there'll be lots of changes or lots of variables coming in. So, for example, the number of units, selling price, the variable costs, and even the fixed cost changes. Okay. So all of these are the assumptions that you've made. So you may say that the number of units may change because of the increase in competition. The selling price may change. You can also say that, for example, it's the threat or the power from customers increased, so we may be reducing our selling price. Variable costs may change. So, for example, they're related to materials, labour, and other, for example, electricity expenses, forecasts. Fixed costs may change. So, for example, you can say that rent expense may change. Okay, you can't simply say that the units may change. Full stop. You need to say that, for example. Okay, use a very, very brief sentence. Will be absolutely fine there. At the same time, in our calculations, so you can see all these variables. So, for example, that we got the tax loss. The policy may change. For example, in relation to taxes, that tax policy on tax loss carry forwards may change by the government. The tax rate may change by the government. Okay. Now, what else? They also have got the royalty. Okay, it's the royalty, basing on the assumptions that will increase by 80%, but that may subject to change. Okay, so the royalty, the 80% may not be successful. So you're touching the case information, and you will get marks by doing that. And also that you've got the discount rate of 12%, but what risks are included. So discount rate of 12%, you can say to the examining team that what risks have been included, business financial risks and so on, and also whether or not that has included the inflation rate. We're not sure about that. Now, any other assumptions that we can also talk about the number of years, because we can start the project immediately, but whether or not that would be the case. So, for example, the years, we can say that 30, start the project now, not be correct, because there might be an option, alternatively, or the chances to delay the project. At the same time, lasting for 4 years may not be possible. Perhaps the technological changes may be coming into being. So remember, if you mention any two according to the marking scheme, that you will get two skepticism mark. Okay, so for any two that you just talk about there. And of course, when you talk about risks, there'll be lots of other risks that you can talk about there. So, for example, the political risks that the government may change or adopt different fiscal and monetary policies. At the same time, the transfer pricing issues may change, okay, because that 80%, if not possible, will reduce possibly the NPV of the overall project. We can also talk about the forex risks that using PPPT, purchasing power parity theory, may not be accurate at all. So when you receive the money back, transferring profit from your country back to our country will be additional taxes. For example, the withholding tax And also that you can talk about the ethics issue. For example, the school will be closed and so on. And of course, you can also talk about the social risks that they may boycott our product in some way or dislike the product. You can also talk about, are there any options? Yeah, so for example, options to sell the project at the end of the 4th year and so on. So the value of that can be taken into account as well. Okay. Now, of course, if you were to analyze one of those in your answer, according to the marking scheme, there will be one ACCA mark that you will get. Of course, finally, provide a reasoned recommendation where it obviously invests that we can balance the financial and non-financial benefit of such, and also we can perform sensitivity analysis basing on that, okay, to consider the risks related to it, and of course to identify the key variable, the maximum that the key variable can change, for example. Yeah. What we could do, of course, we can also make sure that we talk about the business sides, that we will need to monitor the risks carefully. That you can say that one of the most important risks will be political risks. There may be lobbying the government, set up a team to do that for us. Now, in the recommendation according to the marking scheme, that there would be one analysis evaluation mark if you talk about the recommendation, and one ACCA mark if you talk about something that related to real life, and also one analysis and evaluation mark if you talk about sensitivity analysis or the real options. But of course, as a final conclusion, I would say that by doing this project, that will require significant investment upfront. So we need to mind liquidity issue. Okay, so you can get the professional marks by saying that, which means the communication mark for that. Hopefully, not particularly difficult indeed. Now, I would like to sum this to you. Okay, so you can take a picture of that if you like. So that's the report, that's the assumption and risks. And then finally, okay, now that's all for the international investment appraisal for the first question. Now, I would like to stop the tape now, and in the next of our lecture, I would like to go through another question together with you. It's another style, so make sure you're ready. Lamry Company later on. Bye-bye.
APC, accounting for your future.
Welcome back to our revision. Now, we are focusing on examinable area number 2 now. Now, the payback, discounted payback, duration IRR, MIRR. Now, in a very beautiful graph that I created for you here. Now, firstly, let's look at the payback period. Now, what payback period tells us is that when can we recover our initial investment? In this case, is that in year 0, we spend 100 out, but we will get 40 and 70 in year 1 and 2 respectively. So this means that somewhere between year 2 to year 3, we have already recovered our investment. But somewhere between year 1 and year 2, we will be recovering our initial $100. Because as you can see, if we earn 40 in year 1, we still got 60 to go. Yeah, because we spent 100 out and we earned 40. plus another 70, we've paid back our initial investment. So that's why I would like to take, for example, in this case, 1 year plus the money haven't paid back worth of 60, and next year we can earn a total of 70. Alright, so you take 60 over 70. Now that 60 is the cumulative cash flows. Yeah. So somewhere between 1.86 years we can recover our initial investment. Now, the problem with the payback is that we only consider the future cash flows, not discounting future cash flows today, because we are not considering the interest effect. So that's why we can improve it using something called the discounted payback period. Now, discounted payback, we change the future cash flows into present value. Okay, so we change the future cash flows into present value directly. It's done for the fact that we're discounting the future cash flows today. However, both methods will not consider the cash flows beyond the payback point. So that's why we'll need to use the NPV analysis to consider the overall profitability of a given project. Now, let me give you an example. Suppose that we've got project 1 and 2, and year 0 that we spend 100 out, and year 1 we recover all of our investment. However, for project 1 in year 2 we can earn $1, but for the project 2 we can earn 1,000. So if that's the case, it's certainly be the case that the project 2 is more profitable than project 1. But given that they've got the same payback or the discounted payback of 1 year, it doesn't really matter. So that's why the big problem of the payback or discounted payback is that by using this method alone, it will not consider the cash flows beyond the payback point. So that's why we'll need to see which project is more risky by considering all the cash flows. So here we are using something called duration. Now, duration is just to be the risk measure. A lot of students misunderstand the duration with the payback or discounted payback. They are not the same. If you're saying duration was just to pay your initial investment back, you get no marks related to the narrative, and even that you will lose professional marks in saying that. So what I want you to do is that you will need to learn these 3 sentences related to duration. Now, what duration actually means is that, so for example, that we'll need to say, for example, project 1 and 2, that year 0 spending 100, and year 1 we get 60, but get 40 here, but year 2 get 40 and 60 here. So which project is more risky? Well, it seems to me that probably the project 2 is less attractive to us. So to arrive at the conclusion, we need to calculate the duration of project 1 and 2 respectively. Now, the ways that we calculate the duration will be rather straightforward. So firstly, we'll discount the future cash flows into present value, and then we'll only focus on the future cash inflow, okay, rather than the initial investment. Although that we've got the loss in the future, we can consider into that, but in year 0 that we spend money out as the initial investment, we don't consider into that. So all we could do is we take the present value timing by the number of years is the numerator over the total of the present value in the denominator. Now, by doing this, it can give us 3.05 as the duration. So what that means is it will take 3.05 years to cover, for example, in this case, assuming that the 10% will be the cost of capital is 50% of the present value. Okay, so 50%, what does that mean? It's just to be a risk measure, because the longer the duration, the higher the risk of that project in terms of the cash flows variability. All right. Now, at the same time, if we were to discount the future cash flows using the internal rate of return as the second sentence, so the narratives that you can write is that it takes the number of years to recover 50% of the initial investment. All right, if the discount rate that we choose, internal rate of return. As the IRR is just to be the maximum cost of capital we like to suffer. Now, of course, the IRR will be basing on the reassumption that we will assume that the project future cash flows or the subsequent cash flows that we can earn the IRR each and every year, but it is not realistic. So that's why we could modify that a bit by calculating something called the MIRR, or the modified internal rate of return, to change that assumption or the reinvestment assumption at the cost of capital. All right, so it's more realistic. So I would need you to learn these 2 points, because as I said, the internal rate of return, for example, if I were to go to the bank and to quote me is the interest of 10% for this project, but if we were to calculate the IRR of this project being 8%, which means that if I were to pay 10% interest, but I can only get 8% from this project, the NPV of this project will certainly be negative. We'll be making losses from it. And of course, if that is the MIRR, it's just to be the same thing, which means 8% will be the maximum cost of capitals that we would like to suffer. All right. Now, so the calculation will be rather straightforward. The IRR itself, we simply select the undiscounted cash flows. So do remember, you can't select present value, okay, in the Excel. When we are computing the IRR as well as the MIRR. Now for the MIRR, we need to put a comma and then insert the cost of capital, and then comma and the cost of capital again. So it gives us the MIRR. Now the 4 sentences you need to remember or memorize or learn. First is the relative figure. Okay? Either MIRR or IRR will be easiest to be understood by managers. And also, if the IRR, MIRR is higher than the cost of capital, the project NPV will be positive. So make sure that we are always be ready for that. So learning these sort of stuff will be absolutely fine in the question, but it's now to practice a few questions, okay, from a past exam. Firstly, let's see the first question. It's called TISA company. Now we're required to calculate, firstly, the IRR and MIRR of the process omega here. All right then, so we are given the cash flows. Just slot that in your Excel. Firstly, our cash flows omega. So for example, we've got year 1 to 4. So year. Not and 1, 2, 3 and 4. The after-tax cash flows, we're told 3,800 at the very first start, and then 1220, and then 1153, and then 1386. Finally, year 4, 3829. All right. Now, in order to calculate that IRR, will be rather straightforward. You simply insert the IRR formula, open the bracket, and to select the undiscounted cash flows and press enter. and that would be 27%. Simple as that. MIRR, on the other hand, would make the figure a bit less because it changes the reassumption that the subsequent cash flow. So for example, if I were to earn 1,220 in first year, I would like to reinvest that money into the subsequent years. That's called the compounding effect, but not at 27% as the reinvestment rate, but the reinvestment rate will be basing on the cost of capital. Now, in this case, the cost of capital here is 12.75%. So all we could do is that firstly, we insert the MIRR formula, open the bracket, selecting all these cash flows, enter the comma, and then 12.75%, comma, 12.75%, and then press enter. And that gives us 23%. Now, both of these will be higher than the cost of capital of 12.75%. So that's why the project should be going ahead. Okay. Now, whether not we should proceed with the project, and we are given 2 professional marks related to the analysis, evaluation, and skepticism there. So firstly, that per our calculation, both MIRR and IRR are greater than WACC. In this case, it's 12.75%. Comma. It explains the implication on that. So this means that we can proceed with the project because the NPV will be greater than 0, which means shareholders' wealth will be maximised or will be increased. Okay, if we were to proceed with the project. Now, by doing this, not only you will get 1 technical mark, but also 1 analysis and evaluation professional mark here. Now, not just for that, but also you can say it's the MIR, IRR stuff. So, for example, the IRR is basing on the reinvestment assumption. At IRR. So the implication is that it is not realistic. It's not each and every time that we can earn 27% for the subsequent years. And the MIRR, on the other hand, will be to modify this reassumption at 12.75%. Okay, it's more realistic. So by doing this, you can get 1 and 1 technical mark respectively, but at the same time, you can also get 1 skepticism mark as the professional mark here. So that's why the calculation itself, the accounting for another 5 marks, so you can earn a total of 10 marks here. Simple as that in this question only. Right, so moving on to the next question called Fernhust's company. It requires to calculate and comment on the project duration, which means the risk of that project. And we are also given the analysis evaluation mark in your answer, so total will be 4 marks here. Now firstly, we're told about the project from year 1 to 4 about the present value. We're not told about the initial investment because we don't consider that, okay, into our calculation. But the examiner in this case is giving you the percentage of total present value. It's well. But let's do it. Firstly, let's slot the present value from year 1 to 4. Okay, firstly, so year 1, 2, 3 and 4. Now the present values 4104 for year 1, 56.27 for year 2, 68, 26 for year 3, year 4, 82, 69. So all we would do is to compute the duration. So all we would do will be rather straightforward, because we take the present value times by the number of years and then over the sum of present value. That's all. So duration, so firstly, open a bracket, I like to take this times by this. Alright. And so you can do the subsequent calculations on your own. But here, I would like to drag it here. And of course, the sum of present value, so summing all the present value. And that's why the duration, we take the sum of these, because we also need to do the sum of this. Yeah. So sum of the figures highlighted in red. So duration, we take 68,912 over 2486. That will give me 2.77 years. Of course, that's exactly the same as we can see is the percentage of total present value, because all we would do is that we would like to see the sum of the present value, and in this case the sum of total present value is 2486. So we would like to take the present value each and every year over the total present value. So that would give me that 16.5% in each and every period. So all we would do is like to use the percentage of total present value and timing by the number of years here, and that would give me the exact same amount of 2.7758 years. So it's entirely up to you by which methodologies you'd like to use. But more importantly, you will need to say about the narrative. And because we are not told about how you arrive at the present value, so I'd like to slot 3 things here. So firstly, if it is discounted at the cost of capital, this means that it will take approximately 2.77 years or 2.78 years to cover 50% of the present value of the project. If it is discounted at the IRR, on the other hand, so it will take an average of 2.78 years to cover 50% of the initial investment. So don't put this wrong. Okay, so very, very important. You will need to give the accurate and exact definition as I wrote here. Of course, the third mark will be the higher the duration, which means higher the risk. But you don't need to say lower the duration, lower the risk, because that would be a repetition. You cannot get another mark for that. So that's why here, so we've got 3 marks split into, it's like, 2 marks for a calculation and 1 mark for a comment. So another 1 mark there. So that's why this question gives you limited marks, unlike other questions that you can simply write 1 point, but it's entirely up to you. If you can comment on, 2.78 years, what it means in the context of this question, that you will get 1 technical mark and 1 analysis and evaluation mark here. Alright? And with 2 marks for the calculation here, it's absolutely fine now. But sometimes according to the marking scheme for this question, that is 1 mark only for the calculation. So therefore, you can write another point to get 1 technical mark as well. Moving on. The examinable area number 3, we will be looking at the value at risk. Okay. So each and every time that we would like to see is the VAR learn the calculation. So firstly, like to take the standard deviation. So standard deviation simply be the actual cash flows may not be the same as the average cash flow. So as you can see, the actual cash flows will change, okay? So more or less than the average cash flow. And here it will be $30 here. And then we're timing by the number of standard deviations, and we call it as Z. So this will be expressed, okay, in the exam as 99% confidence or 95% confidence. But nowadays, that you are not given the standard normal distribution table. So you cannot find the Z value, but the examining team nowadays will give you that Z value directly. So for example, if it talks about 99% confidence level, the Z value will be 2.33 or 1.65 if it is 95% confidence level. Sometimes the value at risk will be only for 1 year, or it could be over a particular period of time. So that's why you will need to take the square root, which means the power of 0.5 for the duration here, for the time period. So for example here, it is over 4 years, what will be the value at risk? So we just calculate it to be 139.8. So what that means is, over 4 years, we're starting with the t value, and then 99% chance the project would not fall by more than 139.8. Okay. So would not fall, which means at risk. So which means that the value that is at risk will be a maximum of $139.8. But falling by more than that, okay, is just to be 1% chance. So 1% chance will lose more than 139.8, which means 99% chance would not lose more than 139.8. Okay. Now let's practice a question from past exam on the next page. It's called R's Company. Now we're required to calculate the VAR, or value at risk, and recommend which project should be accepted, and provide a justification for the recommendation that explain what the value at risk measures. Now, it seems to me that not only we need to calculate something, but also we will need to recommend which project, and then we will need to slot something in about a justification about this method. And so we are given quite a lot of marks here related to a professional of 5. Now let's see this question altogether. Now we're told that our company is currently considering investment in one of the 2 mutually exclusive projects called P and D. Now mutually exclusive simply means that we need to choose one out of these 2 projects. And P will produce and sell a new range of frozen desert, and D will produce and sell a range of frozen desert, blah blah blah. Okay, I don't really care. And lasting for 5 years, okay, for these 2 projects. And for P and D respectively, that we've already calculated the NPV, IRR, MIRR, I don't really care. And for P, we just calculated at 95%, 90% confidence level for the value at risk that over 5 years will not lose by more than $1,103,500, and will not 90% confidence, 90% chance that we will not lose €60,000 over 5 years. But we will need to calculate the value at risk for drug A. And so we are given the Z value of 1.645 and 1.282 respectively. And we also told the standard deviation here is to be $400,000 for the jockey project. Okay, so as a starting point, if we were to calculate the value at risk, it's to slot the variables in, the standard deviation. You can abbreviate that, it's entirely up to you. The Z value, depending on whether it is 95 or 90% confidence level. And then the time period here. Now firstly, the standard deviation will be the same in each of the confidence level of 400,000. And Z value for 95% will be 1.645. And then it would be 1.282, respectively. And for a time period, it's just to be for 5 years, as I said, that would be 5 over the power of 0.5. Because we need to take the square root of that, which means the power of 0.5, standing for the square root. So that will be the same here. So value at risk would be to use the standard deviation times by the number of standard deviation, which means Z, timing by the square root of t, and that would be this and that. Okay, now once we've calculated, next one we'll need to explain that to the examining team. So for example, in this case, the first is comment on your result. So starting with the years, over 5 years, the first is we've got 95% confidence level, so 95% chance that the NPV for project will not fall by more than how much? According to my calculations, just to be 147,133. You can also say it's a hidden mark here, which means 5% chance the NPV will fall by more than 147,133 here. It's a hidden mark, it's not a repetition. Okay. Now of course you can change the terms, for example from 95% to 90%. Okay. Your answer, so 90%, that's the figures to just calculate it will be 114,6656. Okay, respectively. Now, always comment on your result. That will give you one technical mark, and also one analysis and evaluation mark here. Okay, and that's all you would do. But you also need to recommend which project should be accepted, because you are given two projects, one is called P, one is called D. And looking at the value at risk, for example, focusing on 95% chance that it will not fall by 1.1 million, but here it's 1.4 million here. So it seems to me that the project D is a bit more risky. Okay? It's a bit more risky. Now, I will say that project D is more risky. Because the higher the values that may lose, so higher value at risk, for example, as a starting point. Now, this could be supported by other measures, although we are not given the IRR and MIRR, but we can calculate that, okay? We can calculate that, can't we? So it's the IRR, MIRR, we simply consider the cash flows here. Alright, but we're also told about the cost of capital here. Alright, so cash flows firstly, let's log that in our calculation. So years 1, 2, 3, 4 and 5 respectively. Cash flows year 0 will be minus 11,840. Year 1 will be 1,230. Year 2, 1,680. Year 3, 4,350. Year 4, 10,240. Year 5, 2,200. And that's why in order to calculate IRR equals to IRR open a bracket, selecting all these cash flows, MIRR equals to MIR open a bracket, selecting all these cash flows, and the cost of capital is 10% here. So 10 per, comma, 10 per. So that will be 14%. Alright. Now, just calculated the project for Druggy. The IRR was 16 and 14% for MIRR respectively. Now, of course, both of these will be higher than the cost of capital of 10% and also for the P project. And it's absolutely fine to doing this project and you can earn positive NPV. So I would say that although both projects related to the IRR and MIR will be higher than the 10% cost of capital. So that's why both projects will give us the positive NPV and will increase shareholders' wealth here. So it's fine. There's no difference. Seems to me that no difference for that. But it seems to me that when we are arriving at the NPV calculation, we can also challenge that because we will be discounting the cash flows using the same discount rate at 10%. But since it seems to me that both projects having different risks, so that's why the discount rate should be different from one project to another. So I would say that both projects using 10% discount rate to a certain extent is incorrect or did not reflect different project risks in this particular case. Now, if you were to say that, not only you will get one technical mark, but here, according to the marking scheme, you also get one skepticism mark here. Okay. So that's why, when you are considering the risk involved, it's not to be a clear-cut approach to decide which projects they need to choose from based on one particular financial measure. So that's why you can earn one commercial acumen mark here. So for example, if you were to consider risk into the investment appraisal, so because they've got different project risks, so it's quite different, which means not easy to choose which project to go ahead. That's why they could get one technical mark, but also one acumen mark here. It's very, very tough for you to spot where acumen mark or professional marks are coming from, except for the analysis evaluation. All right. So therefore, you can make your conclusion that, well, which project you should go ahead if you're risk aggressive decision maker. You can consider the druggy project here. Now, according to mark allocation here, it's 1 technical mark and also 1 analysis and evaluation professional mark here. So you can see there that we are given 5 professional marks. Now, we've got 3 already, but also we've got 1 analysis and evaluation. And also that we talk about these more risky, and also there's 1 analysis evaluation mark according to the marking scheme. And there are 6 marks there, so therefore we've got 3 and 4, okay, and then 2 marks related to the calculation here. Okay. And there will be a bonus 1 mark for the calculation, the IR, MIR, but there will be a maximum of 6 technical marks and 5 professional ones. Okay, so make sure they're ready. Now it's time to move on to the next topical area. It's called real options. Now, as a summary that you can see in the beautiful graph that I created for you, is that when performing the traditional NPV analysis, we can only forecast how much money that we can make. So for example, if the traditional NPV of a project is minus 2.88, which means from financial point of view, if we were to invest in that project, our shareholders' wealth would reduce by $2.98 million. Without considering the options that we may be delaying the project, we may be selling off the project at the end of the 5th year and something like that. So therefore, we can calculate the option value using the Black-Scholes option pricing model, the BSOP model here. So plotting that, the total project value will be 6.55. So this means that our investment decision could be basing on the total project value by incorporating the option value, in there. But in order to calculate the option value, we will need to slot the variables right, including, for example, the PA, which means the future cash flows, excluding that investment. PA is just to be the investment related solely to this project. Any sort of sunk costs will not be considered. And also we've got the risk-free rate and the time before we start this project. So for example, in terms of number of years, here it will be 2 years. And finally, we've got a standard deviation. Here it will be 0.3 here. Now, if you were to slot that, you can see the call option value of 9.53 is just to be the value directly given. If you're thinking about the put option, or P for short, we've got the P here, put option value, if you were to dispose off the project at some point in the future. Now, not only for that, you also need to learn the following assumptions if you are considering the BSOP model in your evaluation. We assume everything is perfect, no transaction costs, no taxes, because you can't see any transaction costs and taxes in the calculation itself. And also you need to wait, which means the European exercise term, which means that you will need to wait for another 2 years before you can proceed with that investment. You can know the risk-free rate, but perhaps in real world there will be no risk-free at all. if there's risk-free, why do we have Bitcoin? And also, so we've got standard deviations, so we know that, but standard deviation would just be basing on the average method that we need to calculate. That standard deviation will be changing all the time. Okay, so these assumptions, always learn them in the exam. But it's much better if we were to practice a question here. We are thinking about to launch a new computer game, so reading through the requirements, using Black-Scholes option pricing model to delay the production and marketing of the game. So production and marketing of the game is our decision point. And we will need to see any costs involved related to that decision. All right, so part B, if we were to abandon that project, which means we are focusing an option to sell, but to delay, which means we are focusing on the call option, okay, to buy, to spend more, in other words. And to comment on the implications, we've got professional marks as well. Now we're told that we'd like to develop a new computer game, release in 22 months, okay, that film. So after we've finished that film in 22 months, we will need to wait for another 2 months before we launch the computer game. So if that's the case, that I've got the Black-Scholes option pricing model variables and the formula for you, but you don't really have to remember that because you will be given that. You simply input, for example, time will be 24 months over 12 months. So 24 months because I've got 22 plus 2 over 12 months. If you're very, very confident about that, you can directly slot 2. It's absolutely fine in the exam. 2 years, in other words. So T equals to 22 months plus another 2, and over 12 months, that would be 2 years, they need to wait. So, we forecast the 4-year sales period for the game from year 1 up to year 4, but we will spend 7 at the start of the next 2 years to develop the game, the gaming platform. Well, the gaming platform, we need to produce that, so we will require another 35 for production, distribution, marketing costs. So it seems to me that the exercise price for this particular project, which means production, marketing of the game, would just be 35, and that is the exercise price, or the PE for short. So only the costs related to decision point will be taken into account in our BSOP calculation. So that's why that 35 will be the PE. All right. But how about for the PA? Of course, PA will need to consider the future cash flows coming in. So that's why we need to perform the NPV analysis here. From year 0, which means now, and in 1 year's time, we'll need to spend how much? We're told we'll need to spend $7 million in the next 2 years. And then from year 2 onwards, we will need to spend another 35. And 3, 4, 5, and 6. That's why we can earn 25, 18, 10, and 5, respectively. Okay, so that's the very, very problematic area to most students, that slotting figures in the wrong year. And also we are told the relevant cost of capital is 11%, so discount at 11% there. So year 0, that will be 1, and year 1, that will be 1 over 1 plus 11%, which means 1.11 for the power of 1 year. Okay, so press Shift and number 6, and that will give us the power and open a bracket and selecting the number of years. Press Enter, and we drag it here. That's why so we've got present value. We take the future cash flows, timing by the discount factor, and pressing Enter, we drag it here. And that's why the PA, in the end, that would be the sum of the future present value excluding investment. Press Enter, that could be 38.744. So, equals to this one, according to our working. Now, how about the standard deviation of risk-free rate? So we told risk-free rate 3.5%, standard deviation 30%. So 30% for standard deviation, 3.5% for the risk-free rate. So that gives us the call option value of 9.5265, and that's all we can do. Okay, so going back to the estimates, the financial impact, we are saying to the examining team that firstly, in our calculation, that total project value will be equal to firstly the project NPV. Now, just to calculate the project NPV, by including all the investment, summing them all together, that'll be minus 2.96. So total project value would be the NPV plus the call option value of 9.52. So that could be 6.55. Okay, so estimates the financial impact. Now, if your both decisions to abandon the project, what would be the value? Now, if you slot that into the calculations that I'm not showing here, but I can show you in the exam, in the answer, that we just calculated for you directly. The put option value will be 3.41 here. Okay, it's directly given. Simple. Okay, now in the part B, firstly, basing on the calculation itself, that we can say, sorry, number 2, the value is 3.641, but basing on the part B, discussing the implications, the first we can say, without options is a negative value, so hurting shareholders' wealth, but now it's positive. So 1 technical mark and 1 analysis evaluation mark here. And also stating the characteristics of the BSOP calculations, and also so that you can say not just the delay. Okay, so for example, you can say that you can invest money into the game platform. Maybe lots of programmers can use that to develop other games. All right, so it's the options to expand. You can get 1 acumen mark and 1 technical mark here. Of course, you can say that if a project is successful, there are lots of advertisement, that we can further expand our businesses, for example, into other segments and so on, and any other follow-on project. You can also get 1 technical mark and 1 analysis evaluation mark. That's the professional mark here. Okay, simple. Now, moving on. Now, by revising options, we also need to know about Greeks and delta hedge. Although this is not highly examinable, but you'll need to watch out, because I want you to learn all of these using your own words. So firstly, the option value not only includes intrinsic value, which means the value in cash what's the values that I can get. So for example, if I can buy at 1, but I can sell at 3, the intrinsic value will be 2. That's it. Okay, is to compare the asset price with the exercise price, plus the time value, because you can wait, and during that period, the option value would fluctuate significantly over that period. So time value will increase if the longer duration before you can exercise that option. And then we've got certain Greeks published, okay, by the software directly. But you need to know what is that. So for example, delta, vega, theta, and rho. Well, delta, we are talking about the changes in share price impacting on option value. Vega, we are talking about the changes in standard deviation impacting on option value. Theta, changing in time impacting on option value. Rho, changing in risk-free rate impacting on option value. Which means changing something that impacting on option value. I want you to memorize them. Alright? But how about for gamma? If you're not sure about that, just put the keywords. It's just to accelerate the option value. If the gamma is high, well, I can earn more or I can lose more. Simple. You don't need to know the calculations for that at the moment, but you will need to memorize what is that, okay, in the exam. But related to a calculation part, the examining team may be interested in the delta hedge, and that's why we need to be very careful on this. We're required to calculate the number of options that we need to hold to hedge against the risk of the share price will fall in 2 months' time. Now, I've got a specific mnemonics for this. It's called SO and DS. Now, if we were to know, for example, how many shares do we need to hold, that equals to the number of options that we need to enter into that column chart, and timing by the delta hedge, delta ratio in other words, and then we'll need to consider the size of the column chart. In this case, we will need to work out the options O. But we're told that we've got 200,000 shares, so that's the S. And we also have got the contract size is each option will buy 1,000 shares. What will be the delta ratio here? Well, we're told we need to wait 2 months. So expressing the number of years will be 2 over 12. That will be a t value. And we slot that into the Excel in the BSOP calculator. And in this case, t value here. And we're also told about the current share price is 340 and the exercise price is 350. So 340, which means 3.4, 3.5 respectively for PA and PE. We're also told the volatility and risk-free rate of 40%, which means S, and 4% for risk-free rate. But in this case, because we're afraid the price will fall, and that's why we would be entering the put option contract. Because if the price falls, of course, from put option we can earn money. So that's why that we need to work out the M minus D1. Because D1 is minus 0.055. So minus D1 would be 0.055. And we copy that formally, which means in the Excel, in the exam, you can see that it's the norm dist. So copy that and slot that there so you can see the delta ratio 0.52. So slot that back 0.52, you can work out the number of options contract to be 838 contracts there. If you do the numbers right, you can also earn one analysis evaluation mark. Now, of course, you can see the hedge outcome. So, for example, if the share price reducing by $1, well, the put option value will increase because you gamble it in the right way. But in the open market, the share value will reduce by $200,000. And that's why it balances off, which means hedging works. But you don't really have to know that from my perspective anyway nowadays. Now, of course, we've got another one, or the final topic in this area. It's called capital rationing, which means we haven't got enough fund to do all the positive NPV project. That could be the single period that we lack fund, or multi-period each and every time that we lack fund. That really depends on whether or not the project can be divisible. So, for example, for the ACCA project, it's divisible because we can sell each of the paper in turn. The overall project can be separated. For example, if you're building a bridge, it's not divisible. You need to build it all in order that it works. Now, the way that we assess the utilization of fund will be different. For the project is divisible, we'll need to see the proportion of projects that we can do, given that we've got limited fund. So we'll rank basing on something called the profitability index. So, for example, we use the project present value over the investments that we make in each of the projects in turn, or each of the sub-projects in turn. In the divisible project, on the other hand, we will need to use trial and error methods to see the combination of a project will give rise to the maximum NPV, so we can choose that combination. Multi-period capital rationing, that you only need to know these 3 steps. Your objective is to maximize NPV. The project can either be indivisible, which means your constraints can either be 0 or 1, which means 0%, not doing that at all, or 100% completed. If it is divisible, we need to work out the proportion of projects that we need to do. And we slot that computer and let it do this as a step 3. But more importantly, let's go through the past exam question called a ball company. We are required in a part A formulate an appropriate capital rationing model. Basing on the investment limit, the maximizing NPV for department D, and finding a solution for a model is not required. Okay, so this is the syllabus objective. So that's why we need to read the question. It's a large company with many autonomous departments. It sets the investment limit basing on a 3-year cycle, so which means it's the multi-period capital rationing. Projects selected by departments will have to fall within the investment limit for each of the 3 years. All departments will be required to maintain capital investment monitoring system. So that's why later on we'll see the comments part in the part B and reports on their findings annually to the board. We're also told that the department is considering the following 5 investment projects with 3 years of initial investment expenditure, followed by several years of positive cash inflows. We're told the investment limit will be 9, 6 and 5 million respectively. Alright, so these are the constraints. And we're also told the project's NPV for each of those will be this. Alright, for each of those will be this. So that's why, firstly, our objective is to maximize NPV that equals to, if we were to do the project 01 or P01 if you like, we can get 464. And then we plus, we'll get 244 for project 2. And then we'll get 352 for project 3. I will get 320 for project 4. I will get how much for project 5? So we need to work this out. Because we are not provided with project 5's NPV, but we're told the project 5, the annual operating cash flows commence at the end of the 4th year, lasting for 15 years. The project generates the annual sales of 300,000 units, selling price of 14, development costs in total will be $310,000. Alright? So if that's the case then, if we were to take the sales revenue minusing the development costs over 15 years, and that's fine. Alright? And that's fine. But in Excel, I'd rather use this approach. For example, so that's the capital rationing. So years and 1, 2, and then selecting all this 1, 2, and then for 15 years. Now here, I've done the calculations here. So as you can see, it's very easy to go wrong because we are told the year 1 is immediately, but it's at the end of the 4th year, which means we will need to see that it's not at the end of the 4th year, but it's at the end of the 3rd year. Okay, because year 1 is year 0. All right, so that's why that is at the end of the 3rd year. We put $14 of the selling price, timing by the number of units of 300,000, and minusing each development cost each year, 3.23 million. That'll be 970. Okay, up to the 14th year. Discount at 11%, so equals to 1 over 1.11 for a power of years, and drag it here. And using cash flows timing by discount factor, that gives us the present value. Sum them up, minusing the initial investments now of 2.5 million, and then year 1, which means the year 2 value, but discount for year 1, discount for year 2. That will give me the NPV. A bit different from the answer, but it's just to be a rounding problem. It's okay. It's 393. Okay, from the working here. Now also that we've got constraint. Okay, we've got constraint because the project is divisible, so that's why the iterable project greater than 0 and less or equals to 1. So that being the case, as you can see that for each of the project in turn, for each year, they will be limited to 9, 6, and 5 million. So all we could do is the investment 4,000 for project 1, plus 800 for project 2, plus 3,200 for project 3, plus 3,900 for project 4, plus 2,500 for project 5, that would be less or equals to 9,000. Applies the same to the subsequent one for year 2 and year 3 respectively, is fine. But let's move on to part 2. Provide a brief response to the Managing Director's opinion by explaining why we'll want to impose capital rationing. Well, there are 2 reasons behind it. One is that you're unwilling to raise finance. Second is that you're unable to raise finance. Now, if you're not willing to raise finance, for example, you like to decrease your financial risks, and that's why you're unwilling to take on additional debt, for example. Unable, on the other hand, for example, is the poor economy, and that's why you cannot obtain debt finance or you cannot go listed. Explain the features of the capital investment monitoring system and discussing a benefit. Because it's 4 marks, I would like to discuss the features and 2 for the benefit, okay, of such a system. Now, what do I mean by monitoring system is that we've got a milestone, okay? So, part B, number 2 there. Now, explain that in full sentences in the exam. So, firstly, it just includes the milestone, okay, of each of the MPVs that you'd like to achieve $1,000 stage by stage basis. So, at the same time, another feature is that it has a contingency plan. Okay, so for example, if we were to spot that risk, we are able to invest more related to that. What are the benefits of doing so? Well, firstly, we can identify the most important activities that we need to take care of. So for example, if I were to deal with that project, I will need to input materials, I will need to employ labour, I will need to have the machines in place. So if one chain stops, I can't get materials, I can't get machine going, and the project could be delayed. So the most important feature in this case could be the materials, for example. At the same time, another benefit is that it's a communication device to the managers that what would be your next step. Alright. Now finally, in part C, we're required to explain the figures in each of the 3 output categories. So category 1, total final value, is our objective, which means our MPV to maximise to be $1.184409. Adjustable final values, which means it's something to do with the proportion of a project we like to undertake. So for example, we like to finish 95.8% of project 1. And also category 3, that we've got the constraints utilised or slack, which means the fund limited. Okay, slack, which means the fund still available. Now, in this question, if you're done with the calculation right, any 2 that you can be awarded analysis evaluation mark directly. Now, any comment that relating to part C, in this particular case, that the examining team gives you 1 acumen mark. Hopefully, that you will not find this relatively difficult indeed. Let's just summarise what we have done so far in our core activity or in our Very, very important. Key area. Number 1 is the basic investment appraisal technique that we've got these 6 areas. Make sure so you're happy, and I look forward to seeing you soon in a key area number 2 onwards. Bye bye.
APC, accounting for your future.
Welcome back to the key area number 7, business reconstructions. So what that means is, in this key area revision, we are focusing on how to save a business. I mean, to save a business means the business is not doing a good job, and that's why the public listed company status may be removed. So that's why we need to do something to protect the company from being removed of being a public listed company. Alternatively, we're going to be doing something in order to save the company of not going into bankrupt. So that's why, according to example area number 18, that when talking about the business reconstructions, that could be divided into 3 areas. Firstly, we are focusing on the financial part, which means the financial reconstruction here. So what that means is we will need to think about using, for example, debt to buy another company rather than using all of our remaining cash. So you can use gearing to leverage the returns that we could have got. Alternatively, we'd like to restructure the financial statement, which means the leveraged recapitalization way. So of course, commonly tested that you may be given the current financial statement and using leverage recapitalization. So for example, you pay dividend or you buy back shares. Alternatively, the combining with the debt for equity swap, and you need to project your financial statement, which means the forecasts, your statement of financial position and P&L. The debt for equity swap simply be that you owe money to others, but you can't pay. And that's why you use your shares to pay for that, rather than using cash to pay for that. So of course, the debt for equity swap sometimes could be tested in combination of with the business valuations that we've seen before. So you need to compute the value of debt as well as the value of equity, and to see whether or not both holders would be happy to proceed with that. And of course, we can change the dividend policy. So for example, that instead of paying cash, now we pay shares. Okay, so in other words, bonus issue of shares, or the scrip dividend if you like. The second way of the business reconstruction is called the portfolio reconstruction. So we're actually looking at our divisions rather than simply the financial statements in this particular case. So what we're trying to do is that we could perhaps sell the complete business to others, or selling part of that. Now, if you're selling the complete business, technically it's called divestment. Selling parts of it, okay, so which means sell-offs. Now, when you get rid of your business, which means selling off your business or part of your business, you can either sell it to the existing management team members within your firm or the external management team members. Now, if you're focusing on the existing management team members, this means that it's the management buyout. Okay, so the existing managers will buy out your firm. If the external management team members buying your firm, so this is buying in, because they will need to come into your business, so that's called the MBI, management buy-in. Now what you need to do, very commonly tested, you need to learn that, learning the pros and cons of the MBO. And of course, the management buyout advantage would be the disadvantage of the MBI. Now think about it. You run a training provider business and you sell it to one of your tutors. So if that's the case, that tutor have better knowledge on the operations than the outside managers. So that's why the advantage of the MBO would be better knowledge. And the disadvantage of MBI is that the external tutors may not have the knowledge to how to operate this business. And sometimes there will be less restrictions from the staff because we are familiar with the culture. And also better knowledge on how to improve revenue and to control costs. And that would be more efficient. But disadvantage of the MBO could be that we only have got own ideas because it's run by the own management team members. Perhaps not enough funds. So usually it's that they would like to argue it or to negotiate the price with you, or not having enough funds to proceed with a purchase. Whereas for the MBI, usually they're working with the venture capitalist firms to buy your firm or buy your company. So for the external management team members, that could be an advantage, that they've got enough funds in place. If there are any past disagreements among management team members, and of course if you're running the company on your own with your existing management team members, that you will find it relatively tough for you to do that. So that will be a disadvantage of the MBO. That's the final way. It's what I mean by demerger. Okay, so we simply split the company off into several entities. Now, commonly seen in the exam, as we've seen as we went through the revision in the last sections, that we've talked about spin-off and carve-out. So what that means is we've got that company and we'd like to get rid of the Division A and let it become a public listed company onto the stock exchange. Now, really depending on whether or not that new entity becoming the public listed company, whether or not this entity shareholdings will be held by the existing shareholders. Now, if that's the case, that's called spin-off, if yes. If no, which means introducing some smaller shareholders, which means minority shares. So usually below 20%, so allowing parts of that to be held by new shareholders, that's called carve-out. A very good reason that we're going to be allowing new shareholders to hold shares in new companies that, well, we can sell off part of that share to the new shareholders and get cash. And that's one of the ways that we can do it. But another reason that the company using spin-off rather than the carve-out, not raising additional funds, is that they're afraid of capital gains taxes, okay, in some of the countries. Okay, because if they sell shares to the new shareholders, it's involving cash transaction that may be subject to high capital gains tax. In rare circumstances, we can also see the extreme form of the demerger. This is usually initiated by government, all right, to split the entity into two, and that's it. Now, finally, we also have got business reorganisations by changing the management structure, allowing the management to have more decision-making power, or to improve the corporate governance structure to make it, especially the internal control system, to be stronger so it can create more value in the end. So quite theoretical, really. Now, the exam questions for this area could be that asking you about the pros and cons of the MBO MBI and asking you about, tell me more about what is the merger, spin-off, carve-out. Alternatively, related to the computation part, which means leveraged recapitalisation. All right, by forecasting the financial statement. But sometimes the LBO could be given as one of the background information that the company is going to use debt to buy another company and no more than that. So that's what we are focusing on. Now the first question, New Rimba company asking you about the pros and cons of demerging the sportswear company or business into a new company. Alright, now we're told that the management of the sportswear division approached the company's board with a proposal to buy out the sportswear division. Alright, so it's just to be the MBO. Okay, so we are selling this out, selling this to the existing management team members. But the price was able to offer was insufficient. Alright, so that's why that will be a disadvantage of the MBO. And next paragraph, the board decided that we demerge into a new company called P Company. And same shareholdings, which means that would be an example of a spin-off. And that's a listing company. Alright, now the pros and cons, if you can see my answer directly, if you simply demerge that company, spin off that company to a new public listed company, of course the new entity will have less interventions from the original firm when it's managing the sportswear division in terms of determining the selling price, sales strategy and costing schemes. So to a certain extent you can avoid strict policies to reduce the inefficiencies, and ultimately you can increase the value. Now in the exam, just put an excuse next to that. Don't just say it will increase value. And after that, you will need to say because of the stricter policies don't need to be followed. Now, according to a marking scheme, not only you can get one technical mark on the left-hand side, but also you can get one professional marks related to the acumen mark here. So at the same time, if you were to demerge that company, the new company is not tied to risk attitude by the original firm, which means that you can have a different risk attitude. You could be more risk aggressive and focusing on higher return projects, even though that you need to take on additional risks. And as a result of it, you can have more decision-making autonomy, which means decision-making power. So that's why it can improve the public listed company value, because you are now focusing more entirely on the sportswear business on your own, and you can inject more innovative ideas into that. Just give an excuse next to that. But how about the cons, which means the disadvantages? Well, if you were to list that company, it takes you costs and time to do that. At the same time, instead of sharing the same research and development center, but now you create multiple departments. You're losing economies of scale. Okay, so you double that fixed cost, in other words. Sometimes it will also increase the agency problem, because the original shareholders will have the same shareholding in your company, but the company will be run by another management team members. So the original shareholders will not be the management of a new company in most circumstances. And that's why creating trust problems. And that's why you will need to disclose more about your operation results and also risks of your company. So the costs related to the disclosures, that you can mention that in the exam. According to the marking scheme, that if you're touching one of those, you can also get one acumen mark here. The next question, okay, on the next page, is called Code & Company. Now we are required to explain what a demerger is, that we can talk about three forms: spin-off, carve-out, and extreme form of demerger. Assess possible benefit and drawback, okay, opposed to selling the hotel properties. Now, we're told that the company is the listed company operating in hospitality and leisure industry, and the board recently discussing a new strategy put forward to sell the properties and rent them back. But company then focused solely on the services rather than the properties, and the proposal stated the fund will be used to pay off 70% of the liabilities. And the board is of the opinion that reducing the debt level will reduce risk, but of course in our previous revision that we reviewed, from our calculation that this is incorrect. Yeah, because reducing debt would increase the cost of capital for business. And if the proposal is undertaken that the company focuses exclusively on the hotel services, all right. Now, we've got a demerger alternative. Now, instead of selling the hotel properties, now the board considering demerger the hotel services and a separate property company will own the hotel properties. All right. The property company will take over 70% of debt and pay our company cash for the balance of the property value. So what that means is that instead of selling the hotel properties, but now we're allowing the hotel property to be a new company. And that new company has got the hotel property, and also the company will assume, which means take over 70% of a C company's debt. Now, if that's the case, then whether or not that's feasible. Let's talk about that. Well, the debt holders may not be happy about that because the debt is transferred to the new company. And of course, the existing debt holders may doubt the abilities that a new company, whether or not you've got the ability to pay my money back. So if you touch about that, you can get one acumen mark here. Now, as I said before, that creating a new company that takes time and cost to do that, that would be a drawback. And the benefit, of course, you could say that the value could be more transparent because you can see that one company in one industry. You can focus on key operations, and that's why you can well persuade the investors in the market. And for managements, they've got more decision-making freedom, and for the existing shareholders, that the portfolio unchanged. You're not getting rid of the property industry, may be very good at some point in the future. If you sell that off, of course, the existing existing shareholders may lose potential capital gains from owning shares in the hotel property businesses. So keeping the portfolio unchanged, the original shareholders may be happy about that. All right, it will not really affect your share price, and to a certain extent, the share price will increase. You can also talk about the demerger form, about the spin-off and carve-out. The difference would be whether or not you're introducing the new shareholders. All right, if same shareholdings, that's called spin-off. If you're introducing new shareholders, that's called carve-out. All right, so that's what the Coden company is all about there. Now another company, another case on the next page is called Opal Company. Now we need to distinguish between the MBO and the MBI and discuss why the board may have sold through using MBI, which means allowing external management team members to buy in. Now, of course, when distinguishing these two, you could say that one is focusing on existing and new shareholders. And why you like to use MBI, which means you need to talk about the advantages of MBI. You're getting rid of the old ideas from the existing management team members, and the disagreement by your existing management team members will not exist, okay, if you're introducing new management team members. And also the existing management may not have enough funding, so you can sell at a higher price to the external management team members. Now, you can use this framework to structure your idea because, as you can see in this paper, that although you're given lots of background information, but the extent that you can relate your answer back to those background information will be quite limited, according to my experience. So that's why answer the requirements in the right direction would be the key. Now, second type of question would be testing you about the leveraged recapitalization. So in other words, you may be testing about the projection of the financial statement and make lots and lots of comments on those. So that's why that we are focusing on this question called through fault company. Okay, through fault company. Now, we're required Thursday prepare a projected SFP on the assumptions that we exercise the right to repurchase the shares. Part 2, prepare an SFP on the assumption that the refinancing investment takes place. And part 3, prepare the forecasted P&L. And part B, evaluate what you've done. All right. Now, let's read through the case and see what is going on in there. We're told that 5 years ago, a Pater family invested into a new business called Fluffort Company. And this F company manufactures furniture. And some family members became directors. Others have not been actively involved in management. So therefore, the directors also called the family members, and these are the other family members. Also, we're told that VC, or venture capital company called Gupti Company, or Gupti VC, also made 20% investment in there. Okay, so VC 20% shares. So what if that we buy them back and to cancel it later on? Of course, the VC sends representative to the board to influence its decision making. And also the F company took out a long-term loan at a fixed interest rate at 8.5%. The next paragraph, the sales have generally been disappointing. So as a result, members of the Pater family has been reluctant to invest further in the F company. All right. So over the last year, the Gupti VC, the venture capital firm, have taken a tougher attitude, requesting to pay dividend if your performance did not improve. You will need to buy back the 20% shares. All right. So the VC requiring the company either to pay dividend, or if you're not paying, it's fine. But if your performance is not good, you need to buy back the shares, which means give the money back to the VC. Next paragraph. However, the Fluffort most recent product called e-chair has been a much bigger success than expected. In order to produce enough chairs, the company will make significant expenditure, all right, on that. Now we are given the current P&L, all right, and starting with the profit before financing, income taxes, and so on, and also dividend retained earnings for that. Now, we're also given the notes that saying that the forecast P&L is not affected by the proposed investment. Okay, assume only to affect result after 30th June X9. And we are assuming that the figures shown for the retained earnings can be assumed to be the net increase in cash and nothing to do with the accrual stuff. So making no further adjustment, okay, in the retained earnings, or being cash profit. And we are also told about the SFP, all right. So it's the current SFP here. Right. Now we've got, for example, the number of shares held by each of the stakeholder, and also the bank loan, and with a covenant should be greater than 1.3, and held by the loan notes is held by Reggie Patel. Alright, the loan note is unsecured and is subordinated to bank loan. So this means that to them, although it's a loan note, however, it's a bit risky. Okay, it's high risky loan for that. If no finance is available, non-current asset and so on could be assumed to be the same. Alright. Now, what will be the details of the proposed refinancing? Now, that would be in the part 2, but how about in part 1? If we were to repurchase the share capital back, so what would be the impact on the SFP? Now, let's copy the current SFP in our Excel. Now, number 1 then, for the SFP, we've got firstly the non-current asset being 69. Now we've got the current one, non-current asset being 69. And then current asset being 18. So you can short for using abbreviations called CA. It's fine. And also we've got cash of 7.6. Alright. And we've got total asset, I don't really care. Now we've got share capital of 50. And we've got retained earnings of 2.6. Just copy that. And we've got 8.5% bank loan of 30 and 9% loan note of 5. And we also have got current liabilities of 7. Now, the first one is when we repurchase the share capital back. And we know that the VC holds 20% shares. That's why if we cancel 20% out of that 50, so equals to minus 20% timing by 50 of the share capital. So that's why we can have the share capital being 50 minus 10, that'll be 40 here. Now everything stays the same. So for example, that equals to 69 and so on. However, cash we will need to see as a balancing figure. Alright? Because we'll do other adjustments on that, because for share capital we can see that we are actually also reducing cash for that. Alright. Now, how about the retained earnings? Now, for this year, the retained earnings, as we can see, if we forecast that, that would be 2.4 as the net profit that we can make. The closing retained earnings is a plus, which means plusing 2.4 there as the net profit. And that's why I just drag it here. And that will be 5 there. Everything stays the same, just copy that. So that's why we can work out the cash is a balancing figure, because we've made adjustment in terms of share capital, reducing cash, and also retained earnings, a net increase of 2.4 cash. Now, according to the accounting equation, the asset equals to liabilities plus equity. We use total assets and to minus the equity minus liabilities. That would give me $0 for cash as the balancing figure. That's all. And that's the first proposal. We repurchase the VC's 20% share capital, and that's why we're reducing that by 10. Now, how about in the second one? So, refinancing schedules. Now again, what we can say is that we'd like to copy the current SFP. Alright, here again. And we'll make a certain adjustment. But here, let's look at the details of the proposed refinancing schemes. Now, firstly, the members of the Pato family subscribe to additional 15 million $1 shares at par. And that means the share capital will increase by 15 timing by 1. So here, the share capital will increase by $15 million by Pato family members. Okay, just make a quick note of that, tick for that. And also the VC will subscribe an additional of 20 million $1 shares. And that being the case is 20 here. It's the VC, the increasing a share capital, because we will need to issue additional shares and to sell them to the VC. Tick for that. And we're also told that 8.5 par bank loan to be renegotiated with the bank. And the borrowings increased to 65 to be repaid on 30th June Y5 here. So that's why the bank loan, instead of being 30, but now it's being 65. So I would say that the bank loan is now 65. Alright. The bank loan is now 65. We're also told that loan note will be replaced by 5 million $1 share. Now, Rajiv Patel is holding the 9% loan note here of 5. So that will be cancelled. So minus 5. And to be replaced with a number of shares, with shares value of 5. Alright? So this is what I mean by the debt for equity swap. Okay, so just to make a quick note of that. We're also told that the refinancing means that the non-current assets increasing to 125. Alright, so non-current asset now is 125. And the current asset other than cash increased to 42. And the current liability is to be 12 now. Okay, just lock the numbers in, that's all. We are also told that profit before financing income taxes increasing to be 20, blah, blah, blah. So that relates to the next requirement. And of course, with regards to refinancing, as we can see, that the retained earnings still increased by the profit of 2.4. Alright, same as what we've seen before. Now the profit, retained earnings increased by 2.4 there. Alright. Now that's why if you sum all of these, share capital and then retained earnings and then using 5 plus minus 5, that would be naught. We can work out the cash balance is the balancing figure. Alright? Because every other transaction will certainly affect the level of cash. Do need to put the number of entries in, so for example, it's the minus 5, that being the case is the debit loan notes liability and to credit share capital. You could, but you don't really have to, because you're not required to answer that. But the balancing figure, of course, the total asset equals to liability plus equity. Now we've got liabilities and equity, 90 plus 5 plus 65 plus 0 plus 12. that will be equal to total assets. So that's why we minus the remaining assets. That will give me the balancing figure of 5 for cash. That's all we can do. Now, how about in part 3, that we're required to prepare the P&L on the basis that the profit forecasts are correct. Now, if you look at point 6, the profit before financing income taxes increased to 20 in the first full year and 25 in the second year, and tax rate is 20%. All right. Now, to start off, profit before financing income taxes. Now we've got the first year and we've got the second year, or Y1. That'll be $20 and $25 million respectively. And according to the structure of the P&L, as you can see, this just subtracts the income taxes. Sorry, this just subtracts the interest expenses. Now, what will be the interest expense? Because now that you paid the loan note already. And that's why, supposing that your forecast is correct of the refinancing, the bank loan, you will need to pay interests basing on that $65 million at 10% of the interests in each and every year. Alright? That means that we are focusing on the liability of 65 here and paying 10% interest on that. So that being the case, minus 65 million timing by 10%. Alright? In each of the two circumstances. Now, we've got the PBT, of course, profit before tax, if you like. Just sum all of these. Basing on PBT, which are charged taxes, equals to minus 20%, timing by the profit before tax. And after that, we've got the profit after tax, or profit for the year, or profit, if you like. Just sum the profit before tax and taxes. Of course, how much dividends that you will pay? Now, we're told, point number 6, no dividend will be paid. Alright, so no dividend paid. And that's why the retained earnings will be increased to 10.8 and 14.8 respectively. Alright, because you're plotting these two all together. Now, that's all for the part 1 to 3. I hope it's not very difficult. But now let's evaluate whether the suggested refinancing scheme is likely to be agreed by all finance providers. We know there will be a couple of finance providers, the pay-to family members and the owned by members of the pay-to family, also directors, 55%, and 25% other family members, 20% by the VC. Now, if you can see my answer, that we'll need to see different shareholdings as a starting point. Now, without any sort of plans, currently, the current SFP will show that we only have got 50 million of the share capital. Now, basing on that 50, timing by 55, 25 and 20% respectively, that we can see how many shares, because it's $1 per share, the $50 million over $1, that would give me the number of shares being 27.5 and so on respectively. Without any plans, there will be no loan note holders holding shares. But in the requirement, if you can see the requirement again, that evaluate whether suggested refinancing scheme is likely to be agreed by all finance providers. And of course, according to number 2, or the second plan, that would involve quite a few share capital adjustment by the Patel family and VC and the debt for equity swap. So that would change the share capital from 50 up to 90. All right, up to 90. So as we can see that to 90 here. If we were to focus on the adjustment for each of the directors in terms of examples, the directors plotting 15, as we can see as a starting point, and the VC plotting 20 and plotting 5, respectively. We can compute the number of shares that each of the stakeholder will own and divide this into 90, respectively. That will give me 47.2% and 13.9% and 33.3% and finally 5.6% shares held in the business. So what that means is, as you can see, firstly, from a director's point of view, instead of holding 55% shares, but now only 47.2%, a decrease in shareholdings of the family members from 25 but now 13.9%, a decrease in the shareholdings. But VC will increase the shareholdings. But do you think that venture capitalist firms are happy about that? I will say that the answer is not happy. The reason is that, as you can see, the VC initially has got debt. Debt is less risky than shares. But now swapping that debt with equity, which means that perhaps they're sacrificing the stable cash flows. And that's why for the VC, they may not be happy about that, even though they've got more shareholdings. For long note holders, that now they've got 5.6% shares. All right, so what we could say is that for the VC onto the next page, although that you increase the shareholdings, but you lose stable interest cash flows, replacing that with more risky capital. But perhaps they're happy, all right, because they can demand higher return in the form of higher dividends paying to them. Perhaps they're not happy because, as you can see, when we talk about the covenant ratio, that it may imply high risks. Now, what that means is you can compute the covenant ratio for that, because in the question we are told under the note section number 2 that the loan is subject to a covenant of a ratio of equity to non-current liabilities should be greater than 1.3 as a starting point, which means we take equity over non-current liabilities that should be more than 1.3. So that's why you can be granted with the overdraft facility. If you're breaching that, you cannot get the money back, you cannot get the overdraft facility, or you need to repay the money back to bank on demand. So basing on this, if we were to calculate the equity over non-current liabilities, using, for example, the first scheme, buyback shares, you need to repay the amount because you just calculated to be 1.29. Because for the first scheme, that we are taking the equity of 45, divide this into the non-current liabilities by 30 plus 5. So 45 over 35, that would be 1.29. All right. So in essence, the first scheme, that you will be required to pay the money back to the bank. Although you are repurchasing shares, you are reducing equity, but you're increasing the return on equity, but you're spending money, but not for a complete investment. You simply buy the money back. So you can link this financial strategy that not closely tied to the company's strategic investments. So that's not good for a company's future, for example. In the second plan, as we can see, going back to our second one, basing on the equity in total, that would be 95 over 65 of your non-current liability. That's 1.46. Now above 1.3 of our safe covenant ratio. I would say that the second plan, that to a certain extent you are reducing liquidity risk because you are swapping the debt with equity. You're not really paying the fixed amount of fixed amount of interest that much. But the downside of that, you can also make a comment of those, is that because for the second scheme, that you are making, as you can see, the share capital much larger, to be 90 here. And that means that you've got higher pressure to pay more dividend to more of the shareholders. At the same time, the loan or the bank loan has doubled from 30 to 65. You've got more pressure to pay more interests, i.e. in this case at 10% instead of the original of 8.5%. So you can make comments of that one technical mark. Now the scheme, I will say that for the VC, as we can see, the original covenant ratio, if you're doing nothing, you take 52.6 over 35. That's 1.5. It's greater than the policy. So that's why that would be an excuse to me that higher risk proposal, they may not be happy about that. So VC, according to the marking scheme, there'll be 3 technical marks that you can pick up. Now, how about family members? Now, firstly, the family members. Shares reduced to 47.2%. Now, what if they are not going to be investing for example, at 15 million shares? Well, the shareholdings may be diluted. Okay, so that would be the implication. So it's likely that they will proceed with the investment, although they may not be happy. And some shareholders may seek projects with better returns, so that's why if they are not going to be investing that, they can invest the money in somewhere else. And of course, this would decrease the share price because the original directors are not confident about the company's future. So 2 technical marks you can pick up here. You can explain that implication. If you're not investing that money, shareholdings could be diluted, or they can invest in somewhere else. Now, of course, as I said, we can also pick up another mark that the directors may lose control over that company, because as you can see, instead of holding more than 50% shares in that company, but now less than 50% shares. Of course, in real life, in determining whether or not you've got control over that company, it will also be basing on the past general meetings, shareholders voting. So whether or not there will be more than 50% of the shareholders actually voted in the past general meetings. If the answer is no, for example, according to the past general meetings, that only 45% actually voted, but now you've got 47.2%, even though that less than the traditional or notional 50%, but it's absolutely fine because it's more than 45% according to the past shareholders voting, all right? Because more than 50% of the 45% would be absolutely fine now. So you can argue that you may lose control, but it's not definitely the case that you lose control. But I would say that if you got support from other family members, that you may still control the business. So even though the past voting will be 100% from the shareholders, because they've got 13.9% for that. If you combine these two, they'll be well above 50%. But the key question for the other family members is that in the answer, that also in the case that we can see that other family members are not actively involved in the operations for that. So therefore, the other family members, if they decided not to invest in the scheme, that their shareholdings would certainly be further diluted, even though that the shareholdings has been diluted from 25% into 13.9% after the scheme has been proceeded with. Now we'll say that you can also pick up another two technical mark for that. So for example, the other family members, they may be caring about dividend, all right, if they are not actively involved in the operations of the business. However, that in the case that we are also told there will be no dividend paid for these 2 years. So that's why it will further upset them. Or if they simply look for capital gain, they will say that it's fine not paying me dividend if a company will have better investment chances that may lead to better share price in the end. Okay, so that would be another excuse that the other family members would consider. How about for bank? Now, the bank, as we can see, the covenant's target is 1.3, but the refinancing scheme, the covenant will not be breached because the equity over non-current liability is 1.46. Besides, if you calculate that interest cover ratio, it's well above 2 because you take the profit before financing income taxes over the interest expense is 3.1 for the first year and 3.8 for the second year. It seems that the profitability is improved and the financial risk is not very high because it's not breaching a covenant and interest cover is more than 2. The bank will be happy about that. Now, what suggestions that you can get or you can give? I will say that VC may not be happy. Other family members may not be happy if they receive no dividend. So perhaps the focus will be to persuade other family members and the venture capitalist firm, okay, to persuade them, perhaps changing more plans, giving them more dividend, or changing the status of the loan for the venture capital firm, so make them feel that, well, it's safe, that you can get your investment back, perhaps at least. So you can proceed with a refinancing scheme. All right, so that would be one technical mark here. I'll say that it's very, very tough when you come to the comment part, but you will need to get used to that. So don't state anything that related to theory. You always look for clues from the case and try your best to give, in this case, how many marks for part B? It's just to be 10 marks, 10 points for part B. We work that question on your own before we move on to the next section then. I look forward to seeing you soon then. Bye-bye.
APC, accounting for your future.
Welcome back again. Now let's go through the first question here. It's called Coden Company. It's the next question that we are looking at, the cost of capital. Now firstly, calculate and comment on the cost of equity of a Coden company and also the WACC before and after implementing a proposal, and also any assumptions made. Alright, as a starting point, I will say that before the proposal in my nice little Excel. Alright, so I need to calculate the cost of equity and then whack here. Of course, I will slot the numbers in, but I need to show the working separately because I know that most of the marks will be coming from workings. Now, working 1, of course, I need to work out the cost of equity. I know that 9 out of 10 I will need to use the CAPM, capital asset pricing models, to calculate that cost of equity. Of course, the WACC later on. And underneath that, I need to show you the after proposal, but I will need to read through what is there from the requirement and from the case firstly. We're told that Codan is a listed company in the hospitality and leisure industry. The board discussing a new strategy, putting forward to sell all of the hotel properties. Okay, now this is the proposal. Of course, rent them back on a long-term rental agreement. The company would then focus solely on provision of the hotel services at these properties under the popular brand name. And the proposal stated that we pay off 70% of the non-current liabilities. Now, in the case, it says that if the liability reduced by 70%, the credit rating could be improved to A+. Okay, so A+ simply means that the basis point would just be 60 rather than 90, which means it makes it relatively cheaper for the Codan company to raise additional debt at some point in the future. So that's why that when we calculate the cost of debt in a second, okay, after the proposal, that we need to plot 60 basis points, but before the proposal, I will need to account for 90 basis point there. And the second paragraph, it says that the board is of the opinion that reducing the debt level will reduce the company risk and therefore reducing the cost of capital. Now, do you believe that this is true? Well, the answer is no, probably, because reducing debt, which means that you're losing chances to earn tax savings on interest. And that's why the reducing debt may push up WACC. Okay, because it's more expensive, okay, by relying more on the equity finance. If the proposal is undertaken, the company focuses solely on the provision of hotel services, that the current market value of equity remains unchanged. Okay, so E remains unchanged before and after the proposal. But this is a critical assumption that the question is made, although it's not particularly correct in some way. Alright, so because the market value of equity will certainly change. So you can make that assumption, state that assumption, okay, because in the question it says, briefly explain any assumptions made. So that's why that could be one of the points that you can mention that in your answer. We're also given the extract from the SFP, including liabilities and all sort of equities in there. So you can compute the number of shares possibly by taking 30 to 50 over 0.25. So to compute the number of shares. We'll also be told about the free cash flows to equity, 2.6 million. And it can be assumed that the annual reinvestment in asset is equivalent to the annual amount of depreciation. So this means that we need to plus depreciation but to minus the reinvestment. There'll be no impact on the free cash flows to equity in this case. Over the past few years, it used 40% of the free cash flows to equity on investment and the remaining 60%. Right, while distributing the remaining 60%. Okay, so that means that will retain 40%, we can compute the growth rate for that because we take the retention ratio and timing by the cost of equity. All right. So of course this formula is given as the Gordon's growth model in your formula sheet. And we also told that market value of equities is calculated on the basis of free cash flows to equity. All right. And also we are given the bond are redeemable in 3 years. All right. And the coupon rate was 5.2% there. So we can calculate that coupon interest by taking 5.2% timing by $100 each. And we discounted the pre-tax yield, and that gives us the value of debt. We are given under section 3 there, the equity beta is 1.1, and the risk-free rate 4 par. Premium, which means RM minus RF, 6%. An asset beta for companies offering just hotel services being calculated to be 0.75. So this is the asset beta there. All right. And the tax rate is 20 par. All right. So we've got the credit rating and so on. All right. Now, all we need to do is that firstly, in terms of the cost of equity calculation, we'll say that we are using the CAPM formula, so as always, risk-free rates, beta, RM minus RF. All right, it's 3. Now slot all numbers in, RF being 4 and premium being 6. And how about the beta? Now currently it's the equity beta reflecting the assets and liabilities altogether. That's 1.1 there. So therefore the cost of equity equals to risk-free rate plus beta timing by the premium. That's 10.6%. Okay, that's the starting point. So before the proposal I would say that it's 10.6%. But how about for WACC? So let's start working 2, why not? So working 2 for WACC. So firstly, we've got different sources of funds. We've got the debt and equity. So first we need to work out the value of each and the cost of each and the value timing by costs. All right. We just calculated the equity, which means the cost of equity. So being 10.6% there. How about the cost of debt? Well, where are we? Cost of debt, that we will need to compute the cost of debt timing by 1 minus the tax rate on that. Because given that the credit rating now is BBB, that should be a 90 basis point. Because currently the risk-free rate was 4%. So that's why it's 4% plus 90 basis point, okay, as the cost of debt currently. So some students may say that, well, I've got the cost of debt being 5.2 par, and then timing by 1 minus tax rate. Why can't we use that? The reason is that 5.2 par seems to be quite fixed. It's just to be the previous cost of debt, but we are looking at the current cost of debt because we know that the risk-free rate will be changing all the time. Okay, so the government security yields will be changing, and that's why by taking 4% plus 0.9%, which means 90 basis point, that'll be much better. So therefore, the cost of debt, if you can see on the screen, the 4% plus 90 basis point or 0.9%. And then timing by 1 minus tax rate. So it'll be a tax rate here, it's 20%. So that will give me 3.92% is the cost of debt there. Now we need to work out the value of debt as well as the value of equity. Alright, so let's start working on this, why not? So working on value of debt. Now, value of debt, of course, we've got that value, which means the non-current liabilities being 5.2%. Alright, so what we need to do is we need to work out what will be the market value of each of the individual bond, and then we would like to convert that 42,000 or $42 million from our SFP as the book value into the market value later on. So, firstly, we need to calculate the value per bond. Or we could say is that for the current non-current liabilities is the 3-year bond. So we'll say that years 1, 2, 3. And then the cash flows, of course, I like to take that 5.2 timing by $100 of the par value of each bond. So that would be 5.2 respectively in each and every year. At the end of the first year, I have to repay the amount of principal per bond is $100. That will be 105.2. Discount at the appropriate discount rate, and in this case is 4.9%. Simple. The reason is that currently our credit rating is charging 90 basis points, okay, before the proposal. So that's y equals to 1 over 1 plus 4.9% for the power of number of years, for the power of 1. Just drag them here. It will give me the present value, taking cash flows, timing by the discount factor, drag it here, and sum them up. Therefore, the value per bond is 100.8. After we calculate the value per bond, which means this is the market value per bond, I will need to calculate the total market value. So the total market value, we need to calculate the number of bonds currently, because currently that we've got the historical value of 42,000 here, or in thousand. So I like to take that 42,000 over $100 per bond. Okay, that's the par value. And timing by the market value, that will give me 42,344. Okay, something like that. And that's why the value of debt equals to this amount. Press enter, that's all. How about the value of equity? Now start working on this. The value of equity here, we are given what? We are given free cash flow to equity. And we need to calculate that growth rate on this, because we know the cost of equity and it's absolutely fine there. Now we've got free cash flow to equity. Are there any other adjustments? No, because we're told that the depreciation amount will be the same as the reinvestment amount. So no effect on free cash flows to equity anymore. Cost of equity is just calculated at the very first beginning of 10.6%. And we've got the growth rate. Now according to the Gordon's growth model, we've got firstly the R, secondly is the B. Now B standing for the amounts retained within the business of 40%, and the R standing for the cost of equity being 10.6%. So the growth rates for that, we take the R timing by B, we are expecting the free cash flow to equity to grow at 4.24%. You may say that growth rate may be used in a dividend growth model. Yes, you're absolutely right. But sometimes you can also use that when we are computing the cash flows. It's fine. So therefore, the free cash flows to equity we're told is 2.6 million. Alright. So short for 2,600. So therefore, it's the value of equity. We take free cash flows to equity, timing by 1 plus growth rate of 4.24% over the cost of equity minus growth rate. It's just to be using a perpetuity approach. That's all. They'll give me 42,613. Just slot that back. Equals to this amount. Press enter. So value timing by costs equals to this. Timing by costs. And drag it here. Just to sum all of these. Just to sum all of these. And that's why it's the WACC equals to 176.9 over 84,958. That becomes 7% and something like that. Or 7. It's entirely up to you. 7.3%. So equals to 7.3%. Press enter. Yeah. This is how we arrive at the K-year WACC before proposal. Now, how about after proposal? We're doing to calculate the cost of equity and WACC again. So start working on this. Again, risk-free rates, beta, RM minus RF. Now, of course, everything stays the same except for beta, so 4%, 6% respectively. But how about the beta? Now, to calculate the equity beta value, it's important that we read through the question again, that the current asset beta, but only focusing on services, just to be 0.75, but we get rid of all the hotel properties. So this is applied at the gear exercises, but the debt value has changed because now it's valued at 60 basis point rather than 90 basis point. So that's why, of course, that we've got the asset beta and the debt value, equity value, and debt. Sorry, 1 minus tax rate being 80% there. Equity value stays the same, okay, from the question, and that's why the same as what we've seen before, 42,613. The value of debt has changed. We need to work out that new debt value. Alright, let's just copy the value of debt, okay, from the previous proposal. Just copy and paste that. So you can calculate the value of the new debt. It's not at 4.9% anymore because now the basis point is just to be 60 basis point. So risk-free rate plus 60 basis point being 4.6%. So here, 4.6% and 4.6% and 4.6%. Alright. Not just for that, but we are paying off, as we can see, 70% for debt. So that's why the reduced by 70%. That means the remaining 30% on the total market value here is just to be 12,807.43. Now the new debt value will be this figure. So just slot that in, the new debt value here. Now the asset beta, of course, we're told about 0.75. Now the equity beta, we apply the formula, we work out the equity beta, so you take asset beta over this amount. We take asset beta over value of equity over value of equity plus value of debt, timing by 1 minus tax rate being 0.93 there. Alright, so cost of equity, we take risk-free rate plus beta, timing by the premium. Okay. It's just about 9.6% there. So it's 9.6%, job done. Finally, how about for WACC? Okay, started working on this. Now, again, we've got debt, we've got equity, and we've got the value, costs, value, timing by costs. All right. Value of equity stays the same at 42,614. Value of debt, we just calculated to be 12,807. How about for costs? Now, costs here, after proposal, credit rating is improved, and that's why the spread or the basis point just to be 60% on top of 4% of the risk-free rate. Here will be 4.6% there. Timing by 1 minus tax rate, which means 80%. Cost of equity, on the other hand, we just calculated the very first beginning, 9.6% after proposal. So value timing by costs, drag it here. Drag it down and sum this up. And sum these up. The WACC would be 45.54 over 55.421. Press enter. That gives me 8.2%. All right. Now, if you can compare what is going on, you don't really have to do that. Before proposal and after proposal. First is the cost of equity, second is the WACC. Cost of equity was 10.6 and 9.6 respectively. The WACC, 8.2 after proposal, but before proposal it was 7.3%. So what that means is, after your credit rating is improved, the required return from the shareholders actually decreases. The reason is to reflect the fact that you've got lower financial risks. But on the flip side, the WACC increases to 8.2%. The reason is that you're sacrificing cheaper sources of finance. And that's why you can make certain comment in the exam. I'm showing you in the answer here in bullet point, but you need to make that as a complete sentence. Firstly, why the cost of equity reduced? The reason is reducing your financial risk. But your WACC is increased because you got less tax saving or interests. And therefore it's incorrect, okay, from the board. And you've got one analysis evaluation mark by touching on any of those. The assumptions that you can question the growth rate of your free cash flows to equity, and even that you're not sure the actual assumptions in the free cash flows to equity calculations at all. You're not told about inflation, that kind of stuff. If you show one of that, you can also get one skepticism mark next to that. All right. Now, the next question about where's Parley. Discuss factors may determine how the author will be financed and hence the level of gearing that the company will have. We've got A marks here, and that's why you will need to say quite a few things here. So for example, you can touch on determining how the author will be financed. You can touch on the pecking order theory. And for each of those, you can say least issue costs, medium issue costs, the highest issue costs for the equity finance. You can get another 3 marks. But if you touch on equity finance, it will reduce your share price potentially. So this could be the case that others may see that you're not able to use cheaper debt finance, reducing your share price. Now, if you're reducing your share price, it's likely that the value of equity falls, and this will increase the gearing of a company if you use equity finance. So of course, increasing gearing will increase the financial risks. But using debt finance, you can have these savings, tax savings on the interests. But you need to also talk about the liquidity issue if you use debt finance, and also the refinancing risk, which means whether or not you're able to get the finance back after the debt has matured. But also you can talk about timing stuff, because the share issue may take longer than the debt issue. Now, the professional mark is quite straightforward. In this question, if you're attempting the question, then you will get 1 acumen mark, okay, by touching any of these points that I've listed on screen. Okay, so make sure that each tick that you need to convert into 1 simple sentence, and that will be fine there. Hopefully, so you're happy with the cost of capital. I'd like to stop the tape now, and I look forward to seeing you soon in the next one. Bye-bye.
APC, accounting for your future.